Feed the love that makes us feel like family. It's more than just a slogan. It's the foundation of El Pollo Loco's brand reputation and customer loyalty. El Pollo Loco specializes in authentic flame-grilled chicken and is a player in the vast quick-service restaurant industry, sitting among peers like Cava, Chipotle, and Taco Bell, among others. It is a financially stable company, is trading at low multiples, and has a reliable source of cash flow, but operates in a mature industry, limiting high short-term growth. With that, we issue a hold recommendation with a target price of $11.60, implying around a 12% upside. Over the past 5 years, we have seen El Pollo Loco stock decline due to modest top and bottom line growth, constrained expansion, and headwinds in the QSR industry. As a company, El Pollo Loco is heavily concentrated in the southwestern region of the United States, which leads the potential for expansion into the vast, untapped domestic market. As of 2025, El Pollo Loco has recently surpassed 500 stores with 2 new openings in New Mexico and Washington State. Moving on to their business model, they operate with a franchise-heavy model where 65% of total restaurants are franchise-owned. Despite this mix, 83% of total revenue comes from company-operated stores. However, franchise revenue has been increasing year over year and continues to provide a stable source of cash flow.
Now, jumping into our hold recommendation, it's served by 3 main catalysts. El Pollo Loco operates in the QSR industry with stable but modest growth. Revenue has been primarily driven by pricing rather than incremental traffic, creating predictable growth. Now, from an expansionary standpoint, El Pollo Loco is shifting towards an expansionary phase to gain a broader consumer audience. Compared to relative peers, it's on the smaller scale of the company's perspective, limiting advertising efficiency, brand recall, as well as average unit volumes. Now, this necessarily increases incremental growth rather than transformational growth. Now, shifting over to the franchise focus, El Pollo Loco is shifting towards a franchise-driven model, reducing capital intensity for the business. Now, this doesn't necessarily accelerate top-line growth.
Moving on to our industry economic outlook. We're presented with a mixed bag as United States growth decelerated in 2025 and elevated interest rates and inflation put pressure on the economy. Now, easing policy in the second half of 2025 may provide some relief, but with questions around Fed independence in the spotlight, this adds unpredictability. These are some points we'll go over more, but more generally, the United States quick service sector is expected to deliver steady moderate growth over the medium term, supported by structural demand for convenience and value, including continued adoption of drive-through digital ordering and loyalty programs, leaving brands with strong digital ecosystems best positioned for the future. Wage and employment trends remain supportive, though are moderating. Disposable income has grown modestly, though inflation continues to absorb much of these gains. Menu price inflation has also moderated down from pandemic peaks, though it remains slightly elevated to those pre-COVID levels at approximately 4% by the end of the year 2025. This trend has hit limited service operators like El Pollo Loco less, though, at 3.3%, and with the overall trend suggesting that inflation-driven pricing tailwinds are fading. Despite this, consumer behavior remains a key headwind. While nominal restaurant sales have grown, real growth remains muted due to declining traffic, particularly among lower income consumers who make up a meaningful part of El Pollo Loco's consumer base. Encouragingly, recent data does point to some early traffic recovery in California, though these levels remain negative. Looking forward, industry sales growth is expected to be driven primarily by modest pricing and unit growth as opposed to a meaningful traffic rebound. Moving into our competitive environment, El Pollo Loco operates at a much smaller scale than peers, highlighting limited operating leverage and ability to aggressively reinvest in growth, with peers' scale providing them stronger brand awareness and supply chain efficiencies. El Pollo Loco is stable and produces predictable cash flows, but they are below the scale needed to materially accelerate growth. This does create an inflection point for leadership. With a relatively new executive team, including a new CEO and CMO, the next phase of value creation will be largely dependent upon strategic decisions from management.
Our ESG analysis begins with a peer comparison, noting slightly below average overall ESG disclosure ratings, particularly within the environmental criteria. The company does prioritize food waste reduction as a primary goal through a made-to-order grilled chicken model and hope that by 2030, they're able to reduce their food waste by 50% compared to 2024 levels. The company also emphasizes energy efficiency and sustainability within the restaurant renovation design, signaling positive environmental practices. Moving on to the social analysis, we see a strong emphasis on employee diversity, with 51% of employees identifying as Latino and 63% of employees identifying as female. We would like to know, given the high proportion of Latino employees, we see the current climate around immigration as a potential risk, a factor we incorporated within our valuation. The company operates under a heart-centered leadership approach, prioritizing employee development through restaurant management trainee programs, signaling high employee satisfaction measured by a high willingness to recommend the company as a potential employer. Lastly, Pollo Loco's governance is a strong point within its ESG profile, with 7 out of 8 independent directors and an even mixture of male and female representation. The board emphasizes independence and gender diversity. The board operates under structured auditing, compensation, ESG, nominating, and governance committees with high audit committee representation, promoting strong financial reporting practices. Stock awards have increasingly become a larger portion of director compensation, promoting alignment between board members and the rest of the shareholders. Currently, the board has issued a limited duration rights plan following potential acquisition threats in 2023, emphasizing board commitment to protecting shareholder value.
Now, going into our revenue, we forecast a 2% CAGR over the period of 2030. Revenue has been primarily driven by pricing, but is supplemented by increasing franchising expenses. Company and operated restaurants still make up the majority of revenue, creating a sustainable growth in the long run. Now, going over our profitability margins are stable but constrained. As franchises increases, gross margins expand. Resulting from higher franchise royalty revenue. With that being the case, increase in franchising and operating expenses have shaped down and flattened EBITDA margins. Now, going into our franchise-driven model, El Pollo Loco is expected to increase in franchise expansion. Currently, new openings are primarily franchised, while underperforming restaurants are converted into franchise agreements. Now, from an equal cost trade-off, El Pollo Loco, as revenue from franchises increases, cost of goods sold declines as a percentage of revenue. With that being said, franchising expenses offset much of this, creating relatively stable EBITDA margins. Now, going into our leverage, our El Pollo Loco operates with a strong balance sheet at a debt to EBITDA multiple of 1 compared to the peer median of 4.3. However, comments within the revolver constricts capital allocation towards share repurchases as well as dividends. Now, before going into our model, we do want to address some risks. Primarily, labor is a structural risk, persisting with 72% of revenue within California. As continued immigration efforts still persist, we could see increased efforts in labor markets, exposing margin pressure as well as geographic concentration. Although that may be the case, El Pollo Loco is a sound cash business with also a strong balance sheet, but with continued margin pressure as well as geographic concentration, it can limit potential upside risk.
Our valuation is primarily driven by our DCF model, which accounts for 70% of our valuation matrix. In addition to this, we attributed 27.5% to our Monte Carlo simulation and another 2.5% to our comparable analysis. Our DCF received this weighting due to El Pollo Loco's stable and mature cash flow profile and limited near-term growth. We use a historical average and comparable store sales growth since 2015, excluding 2020 and 2021 due to the outliers caused by COVID. We applied a WACC of 10%, derived from a cost of debt of 8.4% and a cost of equity of 10.7%. We continue to assume in our model that revenue growth is driven from pricing rather than traffic, which is consistent with recent trends across both El Pollo Loco and the QSR industry as a whole. Further, we implemented a 10,000 iteration Monte Carlo simulation where we arrived at a median share price of $11.40. We altered key drivers in El Pollo Loco's business model, including their EBIT margins, comparable store sales growth, and restaurant unit growth. This approach allowed us to better capture uncertainty in El Pollo Loco's key operations. And finally, we attributed a small weighting to El Pollo Loco's comparable analysis due to El Pollo Loco's historical trading point and being a smaller player in the QSR industry. Now, El Pollo Loco does appear attractive at an EV to EBITDA of 6.3 compared to a peer median of 19.72. However, peers do have stronger brand momentum and more compelling long-term growth opportunities.
We emphasize in our investment thesis, company growth is constrained within a mature industry, although a shift towards a franchise-first model promotes margin stability and cash flow consistency. While expansion within current and untapped markets remain a credible source of growth, limited scalability and execution risk support our whole recommendation. We're now open for further questions. Thank you for your time.
Can you go back to where you're kind of projecting revenues? I just want to get a handle on, you said 83% of total revenue comes from company-owned stores.
Here's the first.
But there's way more franchise-owned stores. So I guess what I'm trying to understand in your revenue growth is what's your allocation to revenue? Maybe that's what you're, so the revenue coming from franchise versus restaurant. So,
Sorry, one more time, can you?
no, I'm kind of answering the question because I'm looking at the chart now. Let's see. So the majority of the revenue, I guess it sounds to me like the thesis going forward is that they're really going to focus more on franchise restaurants, yet there's such a small component of revenue compared to the company. I guess I'm trying to understand what the rationale is for going in that direction.
So pretty much, so since 2018, El Pollo has actually seen a 23 restaurant count decrease in company operated restaurants, and they've seen a 23 restaurant increase in franchising. Pretty much, it's just allowed. I will show you too as a percentage of revenue. El Pollo Loco. So since 2020, they're around 13% of their total revenue came from franchises, compared to the most recent year, 2024. It's at around 17% now. They're implementing a lot more franchises because it's just a lot easier for them to scale, and then also have less capital intensity, and they're a lot less prone to volatility and cost of goods sold, so labor costs, food costs, etc.
Yeah, are you concerned at all about kind of input costs, especially in California? Because it seems like most of the stores are in California. You've got a pretty high minimum wage there. I'm not sure if there's so much of an issue with immigration policy. I think it's, you got to pay people a lot too.
Right.
Yeah, the company has started to transition into a POS system. So they're trying to find efficiencies to reduce the labor costs by transitioning to more of an electronic based model where they don't need as many people out the registers. People can order online. They're also seeing a lot of traffic through drive-through. So, you don't necessarily need as many people in the store as they've seen before. And so labor is something that they have been labor costs is something they've been trying to decrease. And this is something that the CFO also mentioned during our call. And so that's why we see this as a not necessarily much of a risk. Yeah.
And I guess also just to add on to that, as they continue to franchise more, they leave all the labor costs to the franchises, so they're less prone, to fluctuations in labor wage.
I have a question, just coming back to the recommendation, 11% upside is the projection. What point would that actually be a buy? Just curious if there was like a line that you guys were thinking about as maybe trending us to a buy. Some people might say 11% is good.
Well, we would say it would turn to a buy if we see just stronger comparable store sales growth. And then right now they're really with new management, they're trying to expand outside California. Recently, like this year, in the most recent quarter, they added their first restaurant in Washington and their first restaurant in New Mexico. So obviously you have a lot of competitors like I guess just in that produce chicken like Chipotle, Cava, Wingstop. These companies are all throughout the US. We need to see El Pollo Loco to firmly have their stance in the rest of the US for us to have that buy. Because right now they're so limited to the West Coast that it affects top line growth and bottom line growth.
I'm going to follow up on something that Donnie said on a similar vein. I saw in your presentation that there were actually quite a lot of things that to me say, oh, that's good. And some of the things you mentioned were digital growth. You talked about expansion in the Seattle area. That actually went really well. And because of that, they're expanding further. The new CEO is pushing in markets where there is a strong, Latino base, which is their customers. And you also talked about some of the costs being more stable, the growth being more stable. So to me, that how do you come up with hold then?
I guess
what is one metric? And you also talked about like the traffic versus the pricing. So yeah, what tipped it to hold?
Well, part of the reason why we issued a hold recommendation, we do believe immigration is a particular risk considering the current climate. The majority of El Pollo Loco's consumers are Latino, specifically in California, and the CFO has also noticed a significant impact to foot traffic within lunch during lunch, and they've also stated that immigration is a potential risk to their labor force. So, given the climate, we don't necessarily believe that they are. We feel like they have potential risk moving on into the future that we necessarily need to see how that goes before we feel comfortable issuing a buy.
And I think another thing is just to add on to that, it's like El Pollo Loco doesn't have this crazy growth that Cava, Wingstop, or Chipotle has, but they're also not a broken company such as like Jack in the Box or like a Dave and Buster's or some, it's another QSR industry like that. They're kind of just like in the middle. They don't have crazy, top line growth, but they're also not broken. They don't have a ton of debt. They're a really healthy company, and they're kind of just in that middle where they're not expanding a crazy ton all across the US or internationally, but they're also not, defeated.
Okay, thank you. Did you do any kind of sensitivity analysis, kind of bare bull?
Yes.
Only because I'm just curious if this is considered a, recession-proof business.
Yes. So we did do a bear and bull case. We altered key metrics such as their TGR and then their revenue CAGR growth over the forecast period. In addition, we altered EBITDA margins and EBIT growth, altering them. And pretty much the main difference in each of the cases is like restaurant growth and then comparable store sales growth. So in our bull case, we assume that expanding to new markets help them significantly, where they're able to increase their restaurant unit growth a lot and also have stronger comparable store sales growth. In our bear case, we assume that entrance into new markets didn't work and their comparable store sales growth declined. And then for sensitivity analysis, we have that. So they're very prone to terminal growth rate changes. We chose to do a 1.5% for our DCF, which we thought was fair, considering that their revenue growth is kind of similar to what the Fed's target rate of inflation is.
Question on the ESG analysis. You obviously went over the various statistics. They still look like they're, from what I can see, laggers relative to their peers for the most part. Do you see that as an area where they're going to get better, obviously with new management, or is that just another additional risk potentially to the company?
We do see that they are lagging in ESG compared to their peers. Most of it is because they don't necessarily disclose a lot of the other types of disclosures like carbon emissions and water waste, which is of course something important to disclose. But from what they do disclose, and they do disclose some positive attributes, like they want to reduce food waste. They have supplier codes of conduct. They have business codes of ethics. They meet baseline regulations established by their operations, right? So they're not necessarily doing anything that's shady below under the table. So we don't feel like they have a significant risk in what they don't disclose, and we feel like they do have positives with what they do disclose. So I wouldn't necessarily see that as a potential risk.
Okay.
Yeah.
Okay. Thank you.
Of course.
I'm going to ask a bunch of questions because of time. So ESG related, following up, Donnie, made me think of, there's a new board addition.
Yes.
How do you think that's going to change the governance? And also you talked about strategy is important in your analysis. So how's it going to change that? One, on the valuation, I'd like to know what your terminal rate is and how you thought about the metrics like AUV or other comps. And then, those are the two questions.
Okay. In terms of the ESG, the new board addition, I believe he's a CEO of Domino's. That's coming up in March, I believe. So we think that'll help the company continue through their progress in trying to expand into new markets. A lot of the board members have experience in growing market share. So we definitely believe that'll be a positive towards their structure.
And then we chose a terminal growth rate of 1.5%. In our valuation, we had a CAGR of 1.9%. So we felt this was justified for a long-term growth rate. And then for AUV, we expect, based on just comparable store sales growth, that it will pretty much grow with inflation, essentially, and pricing.
And then very last question, if I may. What was the biggest debate your team had amongst yourself before coming up with this hold recommendation? What was the topic? What was it around? And how did y'all settle it?
So the biggest debate, me personally, I've been, a El Pollo Loco customer for a long time. There's a lot of sentiment there just based on my family. So I had a strong feeling towards the company. The rest of the team didn't necessarily grow up with that same kind of culture. So they felt that, they're looking at the financials, right? And so we coming together, we had.
Oh,
I'm sorry. I'm so sorry.
Thank you. You'll have to ask later.
We'll have to ask.
That's fine.
You were amazing.
Thank you.
Thank you.
Oh, that's bad. Picnic next time.
I wish I didn't have to go.
I know. Oh, yeah.
Thank you so much.
Thank you, you were amazing.
Appreciate it.
I think just next time, slow down.
No, yeah.
But you were awesome.
I know, because I had the longest part, so I just gotta make sure that I have information going through. Appreciate it.
Pause, take a deep breath. Awesome.
Thank you so much. Really appreciate it.
Thank you.
My name is Caleb Madrid, joined today by Mia Shimon and Winston Ivey representing Chapman University. What if I told you that the crazy chicken was getting crazier? Due to distracted management stemming from activist pressures, persistent traffic headwinds tied to a decrease in consumer trust, misallocation of capital toward non-traffic driving initiatives, an unclear brand identity, and a value-erosive business model that fails to earn its cost of capital, we initiated a sell on El Pollo Loco, supported by a target price of $4.80, implying a 53% downside from the previous market close of $10.38. El Pollo Loco is a Mexican-inspired restaurant chain best known for their fire-grilled chicken. The brand markets itself as a healthy, better-for-you alternative, offering items such as plates, bowls, tacos, and burritos. Additionally, the menu offers non-traditional items such as mac and cheese and gravy. The company operates 510 locations across the western and southern regions of the U.S., a majority of which are franchised, with over 77% of stores concentrated in California. El Pollo Loco generates revenue through company-operated restaurant sales, as well as franchise royalty and advertising fees. Although franchises represent a majority of total locations, company-operated stores continue to generate a disproportionate share of total revenue, resulting in a structurally constrained margin profile. Franchisees are responsible for site selection, build-out, and ongoing operating costs, on top of the recurring royalty and advertising fees that are tied to revenue rather than profitability, creating a structure where execution risk lies with franchisees, yet brand, traffic, and reputational risk remain centralized. Nevertheless, management has emphasized growth through franchising while simultaneously divesting company-operated stores. The result is unit growth without economic improvement, underscoring a growing strategic misalignment, which is especially problematic when viewed within the broader context of an industry where peers have successfully used franchising to drive value creation. The U.S. quick service and fast casual restaurant segments combine for a total addressable market of approximately $550 billion, with the quick service space projected to grow at a 10% CAGR through 2031, and the fast casual space projected to grow at a 14% CAGR through 2029. Despite strong growth, both sides of the industry are increasingly being defined by specialization. Quick service leaders such as McDonald's and Chick-fil-A went on value density and automation, while fast casual leaders such as Panera and Chipotle went on pricing power and customization. In a market where winners have a clearly defined identity, companies trying to compete across both formats see an increasingly difficult path to success. El Pollo Loco's positioning has worsened as the company's historical better-for-you differentiation is weakened. Recurring consumer complaints such as food quality concerns and food poisoning allegations, combined with initiatives to move away from fully fresh preparation, undermine the brand's core freshness narrative. This leaves El Pollo Loco exposed as consumers flock toward either premium brands or value leaders. And these weaknesses are not limited to operations and are increasingly reflected in the company's ESG profile.
El Pollo Loco lies competitors in ESG performance due to weak environmental transparency, employee dissatisfaction, increased governance pressure from activist investor Sardar Biglari, and high executive turnover. Minimizing food waste and transparent reporting are essential for shareholder trust. El Pollo Loco does not publish a sustainability report, nor do they commit to any green initiatives or measurable targets in the future. These risks compound in 2024 when a California class action lawsuit alleged the company misled consumers by labeling its packaging as recyclable, despite being rejected by state facilities. The suit is seeking $5 million in damages and is yet to be resolved. On the social front, El Pollo Loco's employees are deeply dissatisfied. A negative 48 employee net promoter score on Comparably reveals that workers are unhappy, especially when compared to peers, which is a clear red flag for retention and morale. External optics such as food bank partnerships don't outweigh the internal issues that persist. This strain directly correlates to customer satisfaction, as frequent reviews point to low quality and low service. Activist investor Sardar Biglari poses significant governance risk, having applied sustained pressure on the company since 2023. Historically, Biglari goes after companies with entrenched boards and underperforming management. His involvement has led the company to adopt a more reactive and defense governance posture, rather than driving strategic initiatives. Some of these decisions include $88 million in share repurchases aggregated over multiple quarters, as well as the implementation of a shareholder rights agreement known as a poison pill to defend them all. Activist pressures coincided with CEO and senior executive turnover, which disrupts strategic continuity at a critical point in the company's turnaround plan. In addition, only 28% of company executives hold stock compared to 64% at peers, revealing the team has little stake in the game for long-term stock performance.
Over the past 5 years, the company has failed to generate any organic growth. Total revenue grew at a 1.4% CAGR, driven entirely by menu price increases rather than traffic or store expansions. Company operated revenue grew at a 0.26% CAGR, with pricing consistently offset by declining traffic and a shrinking store base. Franchise revenue grew at an 8.4% CAGR, yet not meaningfully enough to shift the earnings mix. From 2025 to 2029, we forecast total revenue to grow at a 2.5% CAGR, which we view as generous. Growth remains increasingly price-led, with limited net store additions and continued refranchising. Franchise revenue grows faster than the consolidated average, increasing to 20% of total revenue. However, company-operated continues to dominate the base, capping overall growth. And profitability tells a similar story. From 2019 to 2024, EBIT grew at a meager 1.5% CAGR, despite multiple pricing actions. Margin performance was range-bound, with temporary improvements consistently offset by store-level cost inflation, particularly across labor, occupancy, and food and paper costs. Looking forward, we do not forecast margin expansion. With fewer company-operated stores, fixed and semi-fixed costs are allocated towards a smaller base, while per-store operating costs continue to rise. This means incremental revenue fails to flow through and margins compress, and this feeds directly into returns. Historically, and in our forecast, El Pollo Loco's returns on invested capital remain persistently below the cost. As invested capital increases, returns fail to clear WACC, meaning that growth under the current strategy erodes economic value. CapEx steps up meaningfully for maintenance levels as management continues to invest in store-level equipment, technology, and remodels at company-operated stores. This higher reinvestment burden materially erodes cash flow conversion, with a growing share of operating cash flow being redirected towards capital expenditures rather than free cash flow generation. From 2019 to 2024, earnings per share increased despite net income remaining largely flat, due to a 20% reduction in shares outstanding over the period, due to aggressive buybacks. With the repurchase capacities now largely exhausted, we assume a flat share count going forward, meaning EPS will track underlying earnings rather than benefit from further financial engineering. And these dynamics directly underpin our valuation framework, which I'll walk through next. Our 12-month target price of $4.80 is driven from a blended valuation consisting of 2 discounted cash flow approaches, a market value-added model, and a relative valuation. We weigh the valuation 60% to DCF, 30% to MVA, and 10% to comps. We place a greater emphasis on DCF and MVA as the company's long-term expansion strategy materially erodes economic value and fails to generate meaningful cash flows. In our market, we weighed relative valuation at a lower amount as it is a less reliable indicator of intrinsic value, given structural differences with franchise and capital efficiencies across peers. Within our DCF, we assume a 7.23% weighted average cost of capital, driven by a 7.9% cost of equity and 5.3% after-tax cost of debt. Terminal value is assessed using both a 2% perpetuity growth rate in line with long-term GDP and 7.2 times EBITDA exit multiple in line with industry medians. Our sensitivity analysis showed a persistent downside, reinforcing our view that projected cash flows are insufficient to justify price appreciation. This yielded a valuation of $3.60. In our MVA, El Pollo Loco's returns on invested capital remain and decline persistently below the 7.2% WACC, generating consistent negative market value added in each forecast year, and this extends into the terminal period, generating a $2.40 12-month target price. Across public comparables, El Pollo Loco trades at a material discount on enterprise value multiples. The company trades at 6.7 times EV to EBITDA versus an 18.7 time median and 9.3 times EV to EBIT versus a 23.1 time median. This, while its PDE is broadly in line with peers. This relative valuation yielded a price target of $20.50. Overall, our blended valuation resulted in a $4.80 12-month target price.
Despite our strong conviction, certain risks to the upside should be addressed. First, A takeover by Biglari could deliver a premium valuation for shareholders. However, given his historically lengthy pursuit timelines, we do not see the probability of this realizing within our 1-year horizon. Second, automational improvements could increase their margins, but capital requirements and system-wide rollout costs will dilute this profitability. Third, lower poultry prices could reduce a meaningful input cost for the company, but commodity markets remain volatile and are difficult to time, as well as El Pollo Loco has their poultry prices locked in at a fixed contract. And finally, an easing in immigration policies could modestly improve foot traffic, but given the administration's current enforcement in their core markets, we do not see this slowing down anytime soon. Therefore, Chapman University reiterates its sell recommendation on El Pollo Loco with a 12-month target price of $4.80, representing a 53% downside. We'll now open the floor to any questions.
What was the biggest debate on your team about the recommendation, and how did you all settle it?
I can take this question. So if we go to appendix with ESG, and so it would be with for Biglari's takeover timeline. Apologize for the lag. So I would say that our biggest debate was whenever we were first looking into the hostile takeover proposal by Sardar Biglari, we wanted to understand the probability of this truly happening and increasing the share price if this were to be taken private. However, through our proprietary analysis and the prolonged time periods of Biglari's attempts, especially with other companies, we ended up generating a consensus that the company would not be at risk of a takeover, and rather management is distracted, and that is how this is affecting the company rather than actually generating a takeover strategy.
So you're settled on that takeover is not realistic? Is that what you're saying?
We settled on the fact that the takeover is definitely driving management into a defensive position. However, we do not materialize the actualization of the takeover happening in real time for the company.
I would also like to touch on that real quick. El Pollo Loco just moved to declassify their board into like a phase 3 approach. So essentially Biglari cannot successfully fully take over the company until 2028. He can begin to start gaining board seats in 2027. But with this declassification, it will prolong this timeline. So he won't be able to just flat out buy out the company anytime soon.
And what was the impact of that debate on your final recommendation?
So for our final recommendation, we view this impact more as distracting the business model rather than a big issue in terms of the valuation or how the company will perform financially. So our aspect here was more, this is going to, drive the business model in inefficient areas. That was the angle that we tried to get at here.
In the beginning, you talked about in your first slide about the misallocation of capital. Can you elaborate on that? And can you also kind of provide some detail into how that informed the evaluation?
Absolutely. So Winston, if you could please go to core deck, I believe it's 7, core deck 7. So the problem that we saw was the El Pollo Loco's problem isn't that it's marketing or people don't know about the brand. And so as you can see from reviews here, people are complaining about food poisoning. They're going to the store and they're thinking, all right, I want to eat some good food, but instead they're getting moths, they're getting bugs inside of their food. And another thing that we saw through proprietary analysis of Yelp reviews was shrinkflation. And so consumers are not only getting smaller portions, but it's getting more expensive. And along with this, the CEO, Liz Williams, recently said that this is not a business turnaround, this is a brand turnaround. And so she's solely focused on marketing and how the stores look, spending money on CapEx per store, such as kiosks, remodeling stores, instead of improving the actual quality of the food, which is the main problem.
And that is why we believe it is a misallocation of capital, as it is not going towards traffic driving incentives, which as traffic driving was going lower due to the fact that consumers are eroding their trust with the brand as they keep getting negative experiences, but rather they're focusing on the marketing aspect.
And did that component find its way into projections?
Yes.
And
So
forecast?
if we go to our Winston, if you go to the appendix financial analysis, historical and forecasted income statement. So Oh, it's not entirely broken down, but I can speak on it. So we did forecast whenever we were doing our analysis, labor expenses to go down as a percentage of company operated stores, because we do believe that is one benefit that they will see, is that they will have the brand spend digitization, have less of a labor requirement. However, with per store operating costs, as I reiterated earlier, those are going to increase, and that does continue to erode the company operated margins as a result of the CapEx going towards those stores.
So question, it seems as though they're kind of in a little bit of a transition period, and they're transitioning from predominantly company operated stores into franchise stores. I guess first question, is that kind of what your base thesis is?
So
what you're saying?
since about, as far as back we've looked since 2019, they've been majority franchise, but they've really turned it up a notch in terms of they're both opening new franchises while also divesting company operated stores to franchisees.
Okay, so with that, was there any sort of analysis to look at, like how profitable are these new franchises on like a per franchise basis, and does that kind of maybe potentially create another risk to the downside thesis if they're getting more efficient, more profitable because they're doing more franchises?
Yeah, so I could touch on this real quick. This is essentially from Sharp Sheets and Vetted Biz, which are, I would say, credible franchise disclosure organizations. Essentially, this is in 2025. As you can see here, the franchise payback period is approximately between 6.7 and 8.7 years. And the profitability of these franchises, what they reported is their expected earnings are about $250,000 to about $310,000. And tying back into your question, El Pollo Loco's main revenue driver and their main source of profit comes from the company operated locations. So as they're divesting away from that and trying to become more of that asset light model through these franchisees, that portion of revenue and that segment of profitability that company realizes from the company operated stores is going to begin to shrink.
So the company operated stores only make up 35% of total locations, yet they generate 85% of total revenue for the company.
Is there anything that you wish you knew about this company that you weren't able to find?
I could definitely touch on this.
Yes or no?
Yes. So if we go to the ESG aggregators, specifically in my portion studying the ESG component of this business, so much of the information was non-existent online. And in my research, I was not able to achieve credible numbers, measurable targets, or anything to really base it off any of their competitors because it simply doesn't exist. They claim to have a board of ESG that's supposed to meet twice annually and perform all these important ESG measures for the company, yet largely this information just simply doesn't exist. I don't know if it's not public or if they simply don't meet. I'm not too sure about that, but that was definitely something I wish I knew more about to give a proper, full, in-depth analysis when comparing it to peers as well.
Even just relationships with shareholders, such as with investor presentations that actually weren't published. So any reports that are published were through a Word document with the logo and the photo. And so we wish that there was more of a relationship with shareholders to really understand what their true message is, and especially on the ESG aspects.
I'm going to jump on Tina's question and add to that. So did you view ESG in your analysis as more on the risk side, more on the marketing side, or more as a growth driver? And which particular metric, to Tina's question, if you had, and how would that impact your analysis?
Yeah, so I could begin here. Essentially, the first thing we want to touch upon is we did forecast a certain cushion with non-recurring expenses in our financial statements. The reason being, this lawsuit is going after $5 million. I'm not an industry expert in law, so I cannot say if the lawsuit will go through or not. But what I can tell you is these specific things like litigation issues is not something El Pollo Loco as a brand needs right now. They're trying to develop their turnaround plan, and increased amounts of litigation issues such as this one regarding the recyclables is something that they simply can't deal with. But yes, in our analysis, we did forecast a slight cushion in terms of the litigation expenses that may occur.
So are you seeing it as a risk, as a more a marketing thing, or a growth driver for the company?
More of a marketing risk.
I also
Marketing risk. What do you mean?
Could you rephrase when you asked? You said
is ESG in your analysis? Are you seeing it more as a revenue driver, more as a risk factor, or more as fluff marketing that the company is doing?
A fluff in marketing that the company is doing. I would touch on that because they claim to have ESG initiatives, or excuse me, They claim to have ESG boards and commitments of that nature, but they don't disclose any information and don't seem to be too prioritized on it. And as a result, issues like this can arise.
Do you have a sense, or I'll go fast, do you know how the activist companies, historical companies have actually performed since they've taken on? And is there any risk that he tries to take it private?
Let me go. Yeah, so I can touch on this as well. Real quick, if we look at Western Sizzlin, originally when he took over the brand, what he does is he takes these companies, uses their cash flows, and funds them into his other investments in reinsurance and oil companies. So essentially what he does is he buys out these companies, deletes half of their stores, takes the cash flows, and uses it as a funnel to his other different types of companies. So if he were to take it over, for example, in Western Sizzling, he took it over and shareholders were returned in debentures, I believe. And then looking at Steak and Shake, he slashed the production of stores. I believe, I cannot give you an exact number, but it was a significant amount. And so, yeah, so historically, he just takes these brands over and uses them as cash cows. So, yeah.
Hello everyone, welcome to Mona. I'm Andrew. I'm also joined by Kristen, Nick, Ashton, and Jaden. And today we're presenting our equity research on El Pollo Loco, also known as Loco, on the NASDAQ. And we're recommending a hold recommendation. This is from a target price of $11.44 with an upside of around 7.6%. This is driven by 4 key variables. Looking at variable cost increasing, this includes cost of goods and also labor cost increasing. And then also we're seeing is surely consumer. We're looking at a consumer that is more looking for more value-oriented products in everything that they buy. Now looking at the 2 other variables, looking at 2 positives, looking at geographic diversification, as currently there are many folks in California, however, they're looking to grow into new markets like Arizona and Texas. And this brings us to our next point. Through this diversification, they're looking to create an asset-light model to franchise into new markets and basically get away from this company-owned restaurants. So now I'll pass it on to Kristen for our company description.
Thank you, Andrew. To understand the investment case, we must first define the asset. El Pollo Loco is a leader in QSR Plus, bridging the gap between the speed of fast food and the quality of fast casual. Their LAMX identity is based on flame-grilled, citrus-marinated chicken, which allows them to compete on the basis of quality without that premium price tag of a Chipotle. But the critical pivot today is their transition towards an asset-light framework. By selling corporate stores to franchisees, they are trading volatile operating income for stable, higher margin royalty cash flows. But the strategy hits a geographic ceiling. Our analysis shows that 80% of revenue is still highly concentrated in California. Therefore, the success of their pivot depends entirely on whether LAMX can scale outside of its home turf. So next, I will pass it on to Ashkan for the industry overview.
Thank you, Kristen. El Pollo Loco operates in the fast food industry, which is expected to grow at about 1% over the next. Now, driving this incremental growth in a relatively mature industry is going to be health-conscious consumers, as well as technology which improves throughput and marketing. But beyond the growth, El Pollo Loco is defined by 2 key characteristics. The first is going to be the market is highly fragmented with no player holding above a 4% market share. And the second is going to be that rising variable costs have increased the importance of scale in this industry time and time again. That's particularly true for labor and food input costs. Now, given those rising costs, we wanted to do a cost pressure analysis on the fast food industry to see where the directional view of the cost makeup. We start in the futures markets, where we started with wheat and corn, we saw a rise, as well as was slightly offset by a decrease in cattle. We equally weighted the 3 to get our food cost pressure for the fast food industry. We then moved on to labor, where we used 2025 wage growth as 2025 wage growth as a proxy for 2026 wage growth. Now that we had both food and labor growth, we equally weighted the 2 to get our 2026 cost pressure for the fast food industry, which was approximately 5.5%. Now, it is important to note that this isn't a forecast, but more of a directional view of where we do see the costs heading in this industry. Now onto the competitive side. For El Pollo Loco, we want to compare them to competitors that have similar offerings. That's going to be chicken-centric as well as Mexican-inspired fast food products. Key competitors include RBI, Yum, as well as Chipotle and Jack in the Box. While we were doing our research and looking into some key metrics, we saw that El Pollo Loco underperformed in 2 key metrics. The first being same-store sales, where since 2015, El Pollo Loco has relatively underperformed its peers, never really outperforming in any year particularly. We then looked at restaurant level margin, where we saw when you average from 2020 to 2024, El Pollo Loco has generally underperformed its competitors at 16.5%, while its competitors generally achieved 18.5% or more, with the exception of Yum Brands. But it is important to note that this isn't necessarily an issue with El Pollo Loco's key offerings or where they position themselves within their offerings. It's more of an issue with their geographic density, with 72% of their locations being in the greater Los Angeles area. And while they do have their chicken-centric as more of a health-centric approach, and their Mexican-inspired, Los Angeles area does offer these products in abundance. While that concludes our competitive forces, I'll now pass it on to Nick with financial analysis.
Thank you, Ashkan. From 2020 to 2024, El Pollo Loco has seen a revenue CAGR of 2.8%. As we can see, revenue is not their growth story. After experiencing some cost pressures in 2022, such as food and labor, they have steadily been improving their restaurant contribution margin. Overall, with their pivot towards their light asset model, as well as their restaurant contribution margin improvement, we can see that profitability will be a key aspect of their growth. In 2025, El Pollo Loco set out to build 10 new locations, which they did, mostly outside of California. For 2026, they plan to double this goal, building around 20 new locations. Currently, El Pollo Loco is slowly but surely penetrating non-California markets, even if they may struggle to raise brand awareness in the short term. El Pollo Loco currently has a revolving credit facility that is eased by Bank of America called the 2022 Revolver. It has a limit of $150 million, which they sit comfortably below consistently. They're currently at around $69 million on their balance. The 2022 Revolver offers a floating rate, which is calculated on SOFR plus a spread that is based on their leverage ratio. As of the end of year 2024, this rate was around 5.7%. Overall, we believe El Pollo Loco is modestly leveraged and that they will continue this disciplined debt management strategy into the future. I will now pass things to Andrew with valuation.
So for valuation, we tend to take two approaches. The first one being trace valuation, weighted higher at 60%, as we believe the DCF gives a better look into the operating model of the business. So we tend to do a DCF of two different stages. Stage one presents the first 5 years of growth as it look to diversify into new markets through the asset-light model. And for that reason, we decided to use the WACC of 6.94, and then look at the stage two. This is going to be more of the steady state once you're done growing into these new markets and basically get the gain of these franchises. And for that, we use a WACC a bit lower of 6.69% and a terminal growth rate of 2%, which is a historical growth rate, which we believe El Pollo Loco grow to in the terminal year. So the second valuation that we did was relative valuation. We did a bit less. However, we did capture the same and industry analysis, plus some more that we believe target the same market and as well contribute to the same type of product that they offered. For that, we decided to use 4 different multiples, 2 sales multiples and 2 profitability multiples, all equally weighted to capture both the growth and the profitability section of the company. For that, we got an implied share price of around $10. And once you blend it all together, we get an implied share price of around $11.44. So now I'll pass it back on to Kristen for our ESG.
Thank you, Andrew. Moving on to ESG, here headline metrics can be deceiving. Bloomberg assigns a low score due to disclosure gaps, but operationally risk management is robust. On the environmental side, we saw that Loco proactively mitigated against regulatory disruption. They implemented sustainable packaging 4 years ahead of California's strict styrofoam ban. On the social side, we see a dual advantage. Loco has a menu that is structurally aligned with the new GLP-1 economy. They offer high-protein grilled options that health-conscious consumers are demanding. They also maintain a margin shield. They have employee turnover rates significantly below the industry average, which lowers their training costs and also helps protect their margins against wage inflation. Lastly, we have governance. We view the 15% stake from activist investor Biglari Capital not as a prediction of a takeover, but as a structural evaluation to support it. So the aggressive accumulation of smart, fast money is going to absorb liquidity and help protect against downside risk. So what we have is a symmetric risk profile, capped upside and protected downside, which further enhances our hold recommendation. So with that being said, I will now pass it on to Jaden for the investment risks.
Thank you, Chris. Like every investment, analysis is not complete without looking at the risks. When we look at El Pollo Loco, we do see some risks. The first risk is a macroeconomic risk. El Pollo Loco faces exposure to macroeconomic conditions that affect consumers. Rising interest rates, higher inflation, or economic downturns could all negatively impact its customers' ability buy takeout meals or dine in restaurants. Next risk is a franchisee risk. 66% of all El Pollo Loco restaurants are franchisee run. This is exposing them to risk. Economic downturns, rising costs, overall poor financial management could lead to franchisees struggling or declaring bankruptcy. The last risk is a debt risk. Despite El Pollo Loco's disciplined debt management, they still do carry long-term variable rate debt. This exposes them to interest rates or fluctuations. Their debt requires consistent payments, and heavy use of its credit line could negatively impact their ability to fund operations and investments. So overall, we want to reiterate our bold recommendation. In the near term, we see tightening margins with rising costs. However, in the long term, we see expanding margins through their asset-light model that they get through franchising. Thank you all. This concludes our presentation, and we'll now open for Q&A.
You were kind of talking a little bit about, it's kind of low-cost food, but I think you were talking about it being kind of a positive with inflation. You're talking about the macroeconomic risks. So is this a recession-proof company? Like, could it be a positive that they have, affordable food, and this maybe isn't a risk if the economy goes the other way?
I think maybe to an extent. My main point is that the inflation might hurt their consumers, and they might shift away from eating in restaurants like El Pollo Loco or purchasing from them. And so they might shift, even though we think that they're good value and high quality, they might shift to something that's lower cost because that's all they can afford.
Okay. The other thing I was going to ask about on page 6, you talked about kind of the wage growth, and I think you really looked at it more nationally, maybe. Did you look at this specifically with California? Because you've got, minimum. Hell is it? No, the minimum wage. Yeah, that's it. The minimum wage thing is $20, I think now. So that to me is a little different than what we're looking at across other areas. So did that flow into any of your analysis?
Well, we did keep it national because we did want to represent the whole industry as a whole at this point. And then on to like another point that we also thought about was that El Pollo Loco is looking to expand more and move into other states. So while yes, they are currently highly concentrated in California, they are still expanding. So that was our want.
Okay.
And to add to that, they do, the $20 minimum wage is like a hurdle for El Pollo Loco being heavily concentrated in California, but they also have that perk where they have, below average employee turnover rate. So that's kind of like a hedge for them, which helps them out.
What's the biggest debate your team had while you were doing this analysis, and how did you all settle it and come to the recommendation you did?
I think the biggest thing was whether to see if it was either between a buy or a hold, because the biggest problem we're seeing is the biggest driver of our model was the profit margins. And one of the big discussions we had, are they going to be decreasing for how many years? Or and then kind of rebound how many years after that? So that was kind of like our main things that we're kind of struggling to kind of show you guys and kind of put our model together. However, the main reason we got to the final conclusion to that is to kind of look at the industry analysis, how it's the whole industry going to happen, what's going to happen to them. Also just look at the consumer as well, because they are a consumer focused business, and we are seeing more people look for value focused items. So obviously, maybe the top line's going to be a bit shrunken down in the first year, which obviously with the variable costs, the profit margin is going to be a bit more shrink a bit more. However, we do see that going away in the future, which we can see in the evaluation section. We get to that real quick. Right here, we do see kind of a big steep down in 2026. However, it's going to be rebounding up once we get past those few hurdles in the first short-term years.
You said the main debate was between buy and hold. So how did you settle on the hold? Why was it not a buy?
Yeah, great question. So one of the main reasons, because currently they are facing a bit of more of a short-term problems, as I mentioned before. Obviously, the consumers will be struggling as we saw this past year, and we do believe that to remain true for this following year. And we do see a big positive in the future. So as we can see here, they're going to take advantage of this new asset-light model as they take away from all the costs of those company-owned restaurants to more franchise restaurants. So they're going to benefit from collecting those royalty fees.
And also kind of like I mentioned, that symmetric risk profile, So their upside is being capped because of that geographic ceiling. So they are trying to expand, their franchises outside of California, but obviously that takes time because one of their things is having high quality food. And when your headquarters are in one state, it's hard to kind of keep that high quality when you expand so far. So that's going to take time. But it's also protected by that downside where they have these activist investors, Biglari Capital and Capital Spring, that are taking considerable stakes of the company, which is going to help management act in line, which makes the company profitable because that's what they want at the end of the day.
Question actually on these two pages. So here, 60% of your valuation methodology went towards the intrinsic value, correct?
Yes.
Do you have is there a price, like what was the price target based off the intrinsic value model?
The intrinsic value, it was a bit higher from the $11.44. It was around $12 and like 40 cents, like $1 extra.
Okay.
But we decided to also include the relative valuation to kind of ground us into more.
Perfect. Okay, so my other question here, as it relates to intrinsic value or relative values, go to the next one.
Yeah.
So you did 60-40. Question would be, so if I look at these and I'm reading it correctly, you got low first quartile, median, average, third quartile, and I'm assuming then there's top quartile. The range for each one of these metrics between like the low end and the high end seemed pretty wide.
Yeah.
Right. So was there any concern about using 40 or allocating 40% of your valuation methodology to this when you have such a wide range of potential outcomes? And I guess what I'm kind of also getting at is, are the competitors, like, are they true like competitors from a valuation perspective? What do you think?
Yeah, great question. So that's actually one of the things also that we kind of struggle to kind of keep in line, because obviously this is such a wide industry. But we decided to keep the same industry competitors we saw for industry analysis, plus some more that we saw people like going towards to more value oriented things. Doesn't not necessarily just chicken, but just anything that's kind of the same price range, targeting the same consumer, using the same marketing tactics that we're seeing a lot of these like fast food, like fast casual that people pushing towards to. That's kind of like our main logic behind it. So it's not necessarily just chicken. We're also looking at same type of strategy for targeting the same market.
So any thoughts on potentially changing the weightings of intrinsic versus relative value because of that?
Honestly, I think weighing in the DCF a bit more probably the only logical thing for us, because it gives us a more of an in-depth look into actual business, because this is just looking at multiples from like other peer sets.
When you're going through all of your analysis and you were doing research on the company, was there something you wish you could have discovered or learned, or something that would have helped that you weren't able to get?
I think for me, a big part of my work was evaluation. And one thing that I learned is that you can do two-stage like wax and things like that. So I didn't know that, which kind of held us back a bit. But after I kind of learned it, I wish I knew it beforehand. It would have been much faster. We could have had a better analysis with more understanding of business and stuff before actually trying to learn, the bottom up beta and things like that. So
you talked about, the lower cost of certain things. I liked how you did the analysis. But my question is, how does that play into, like, have you ever thought about, you briefly mentioned that they're doing some more digital, they're doing some menu innovations. How does that play into your thesis? And how did you think about that?
Yeah, so in terms of like the story, it's more so like, for example, for like the menu innovation and like the health conscious, has been like a long-term story in the fast food industry. And it does change like relatively, not frequently, but it does have its trends where sometimes the things that the consumers view as healthy does change. And right now it is like a protein dense diet, which does kind of play into like El Pollo Loco's positioning, which is why we think over the like, maybe not short term because of like other factors that might push down El Pollo Loco, but long term, they are positioned well in that protein dense what like consumers are looking for today. And then in terms of technology, we didn't really affect that too much because El Pollo Loco's positioning in technology isn't much as when we spoke to him, but it's not something that's out of question. But maybe he can speak more about how directly.
Yeah. So the main purpose that the technology part basically influenced our analysis basically going to be in the margin again, as previously mentioned, the bigger driver. When we spoke to the CFO of Pollo Loco, he did say that implementing new labor technology to basically mitigate and help with the saving money with labor and things like that. So obviously, as you mentioned before, California has a high minimum wage, so that's gonna help them, kind of balance that out.
They've also updated their kiosks, they're doing more with AI on the digital app. How did you factor that in?
Yeah,
They're
so
using that to actually try and drive revenue. What are your thoughts on that?
so you're just to rephrase, I'm sure I understand your question. You're asking how the app and like all
Yeah,
the
they're pushing the digital tools as well, more like the AI and with their app and their kiosk. Yes, on the labor side as well, but also on the revenue side. So just want to hear what your thoughts are on that,
Yeah.
how you factored that in.
Yeah, so obviously that's I've seen from previous like other competitors that have implemented that or have been very quite successful in that space. So with that they push a revenue quite by a small amount. It wouldn't be such a big amount, I would say, because they are still kind of growing. I feel like people that already know Pollo Loco, they kind of into it and they already know what they like. So I think the bigger part of that is kind of just pushing the marketing, make sure you get their voice out there, which I believe is working, especially in these new markets. They are pushing it, pushing that marketing, also get them the app and things like that.
Yeah.